You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program here on the Options Insider Radio Network, where we break down everything going on in the world of options for you, the busy financial advisor, asset manager, because you're busy at the end of the day working with your clients, dealing with your clients. And there's certainly a heck of a lot going on just in the markets alone to keep you busy, let alone being able to follow and stay abreast of the latest development strategies, tips, techniques, all the fun stuff from the world of options. Thankfully, we're here to do it for you. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Pleased to be joined once again by my cohort, my partner in crime for all things Advisor's Option, Mr. Matt Amberson, a.k.a. the Oracle of New Hampshire, a.k.a. the principal over there at ORATS, a.k.a. Options Research and Technology Services, a.k.a. the keeper of all the cool data you folks are always asking about there these days. Mr. Matt, welcome back to the Advisor's Option, sir. It has been too long.
It has been too long. I am a registered investment advisor. I wasn't when I started with you guys, but I am now. And
we lured you to the dark side, sir.
And I work with many investment advisors that are asking awesome questions about option strategies and taking care of their clients in the best ways, and all the new tools available for them. So a lot of fun to be here, Mark.
All right. And we are also joined in the guest spot today by a newcomer to this program, even though it's been on the network in the past, Mr. Gary Franklin, the Vice President of Options Trading and Strategies, easy for me to say, over there at Raymond James. Gary, welcome to the Advisors Options, sir.
Thanks, Mark. I'm glad to be here and always excited to help educate and offer what we have learned over the years.
And Gary, like I said, this is kind of your first time really on this program. So why don't you go ahead and give our audience a quick overview of what the Vice President of Options Trading and Strategies does at Raymond James day to day?
All right. Yeah. Actually, August marks my 31st year in the industry.
Wow.
And oddly enough, basically the same company, survived through a couple different mergers, but kept my seat along the way. Never actually had a resume. I was told, hey, go see this person. I think you can get an internship. I started at $5 a day because they wouldn't let me work for free. And kind of parlayed that over the years. Fell in love with options, moved to the options desk, started running the options desk within 3 years. And started mostly on the trading side, then saw as the market was changing and the industry was growing, the strategy side of things. All right, how can we make the life of the advisor and the end client easier, right, with the proper use of options? So that's really where the strategy side came into play for us over here at Raymond James.
All right, then let's get to it. It is time to kick things off with the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement. Ever since the pandemic began back in the early portion of last year, we've seen unprecedented developments in terms of the markets and valuation and volatility and pretty much everything in between. And since we were pretty much forced to address it every episode anyway, it seemed to make sense to turn it into its own segment. Thus, the P&L statement was born. Gary, you're our guest, so perhaps we'll start with you. Obviously, a lot is going on out there in the broad market. We continue today a little bit of a brief respite, but mostly continuing this inexorable march to the upside in the broad equity markets, and indeed a usually somewhat interrupted every now and then, but usually uninterrupted march to the downside in terms of broad market volatility. What's been lighting up your tape and catching your eye and the eyes of your clients over there at Raymond James these days in these somewhat turbulent markets here, Gary?
Yeah, for us, I mean, the volumes have been great, and some of the conversations are, I've got new money to put to work, but yet the market keeps grinding higher, and who wants to be the one that puts their money to work at the very top, right? And I always say, look, you need to get started. Let's say put in a quarter of your funds your new cash that you just came into the market. Get out there, right? If the market continues higher, you've got a quarter of what you brought in already in the market. If the market moves lower, okay, you can add another layer and average down. And have that process of keep everything going. And I really, the more I think about it, this market kind of reminds me of pre-Y2K. Where we've got so much money pumped into the system that it's just has no choice but to go higher. When will the music stop? Nobody really knows. But at this point, the old saying, "Don't fight the tape," and the same thing was going on. If you guys, some of your audience maybe is not old enough to really understand the whole Y2K scare where everybody thought our computers are going to crash when it rolled over to 2000. But it kind of feels that way to me, this market where, it just keeps pushing higher and valuations. Well, why is my company not worth the same as the other company? We're in the same space. They're worth 2x what we're worth. Well, forget valuations of book value and all that kind of stuff. I think I should be on par with my peer or greater. So we've got a lot of that's going on. So my focus is be tactical, but you also got to be in the game. So that's kind of a lot of our discussions around this current market and kind of how it feels.
It's been a challenging thing, and it's pretty much a discussion we've been having almost ever since this V-shaped recovery began, right, Gary? People are getting a little bit leery when they saw it keep rallying, and now that rally has continued for over a year. So you're right. No one wants to be the last guy in before it turns to the dark side, but also you want to have some skin in the game. So challenging times are afoot. Mr. Matt, I know out there in the land of ORATs, you folks are just getting bombarded by pretty much these types of questions right now. I know you're also running a lot of different models day to day, keeping an eye on volatility and valuation and just about everything else under the sun. Skew, what's been lighting up your tape and what are your models telling you out there these days, Matt?
Yeah, I agree with Gary. You have to be in this market, even though it seems crazy. How do you do that responsibly? You're on an option show here. Of course, we're going to say you use options and you use them to protect your downside. That's not new. I mean, if you go look at we call it the slope, but if you look at the puts versus the calls in an implied volatility of the S&P 500, you're going to see that it's extremely high, 75th percentile plus, and the only reason it's not 100 is because it's been there. It's been pinned on the highest slope for quite some months. So a lot of people are in the market, holding their nose, getting protection. But as that slope gets steeper, the protection gets more expensive. The put implied volatility goes up, the price of the puts go up. So as you say, we're doing a lot of testing. We've been coming up with some interesting back tests for folks. We have to get more and more creative. So that's what we're seeing out there, Mark.
All right, then with the table set, let's keep on rolling with the party right on into the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the earnings volatility report.
All right, it's that time of year again. Listeners, it seems like it's always that time of year, but we're kind of still in it these days right now from an earnings volatility perspective. Luckily, we have the guy on the show who crunches all the numbers out there, mostly because I held his feet to the fire and I said, hey, Matt, this is some cool data. Nobody else is doing it. And I'm glad to see you guys have really taken the ball and run with it, Matt, because a lot of folks are really enjoying it. And, we've been talking about this for a little while now, Matt. When is that moment? When is that inflection point? When is the worm going to turn? It seems like, dare I say it, maybe we're seeing some hints of that out there, sir. What are you seeing from your numbers? And are we on that precipice? Is the worm about to turn, sir?
Yeah, you did get us to do this, Mark. And what we do is we have Gary's been in the industry for a long time, but so have I. In the 90s, I was a market maker, and people used to come in and usually sell us fall around earnings, and then one time they'd come in and buy everything, and you were going to get killed. So we measure. We look at the straddle, and you can't just look at the straddle and say, oh, it's going to move that amount. You have to look at how much time is left in the straddle, because there's going to be some residual value left over after this earnings move. And so we have so much data that we can predict an earnings kind of distribution and where the straddle might be priced at each part of the leftover distribution. So we come up with a straddle earnings move, and then we look at the actual moves, and so we really get into it. And then we not only produce these kind of daily reports that we're coming to an end with this earnings season, but we do a earnings move season report, and the season has about 6 weeks to it, and we go through each week, break out the performance and see if there's anything there, and lo and behold, there is something very big there that's repeatable. And as you alluded to, this last year of COVID craziness and also valuations, as Gary was talking about, has actually overshadowed the actual earnings moves that we've seen. So the way that we measure that is we measure this straddle, and we measure how much it actually moves, and it's been anemic for the better part of a year and a half. And then we've been predicting, if you predict something long enough, you're eventually right. That's what I feel, that we finally are seeing that earnings matter. Earnings lives matter, Mark. So finally, we're seeing some what we call green on our season report, showing owners of the straddle have actually made some money. We were looking closely at this earnings season, dipping our toes in helping our clients out, looking at our reports and trying to figure out what are the usual better movers. It's funny, as you look back through it, the ones that tend to move the most are the ones that are usually the highest implied valuation versus history and versus what the volatility will fall to afterwards. So we do think there's some leakage there, or at least some very smart people that have some concept of when the stock is going to move. But that's a long way to say all that's going on in this earnings season. It was a beautiful earnings season from that respect. We hate to see red for a year, and finally we're seeing some even-handedness. So that makes it a lot more interesting for us, Mark.
Yeah, it is a little bit interesting when the worm starts to turn fine. I'm looking at the earnings season report right now, updated as of yesterday. Listeners, you guys can find it for yourselves, theoptionsinsider.com. Click on that options, news, and articles tab. You click on that earnings reports tab. There's a whole section of the site just for these, pretty much. You could spend your days surfing through all that. I know a lot of you are out there. And if you look at that right now, you see the most recent report. You'll see that earnings season. You'll see a couple of things that will stand out at you. First off, the last couple of weeks here, Week 4 as at 107%. That's a number we haven't seen in quite some time. Week 5 at 100%. And both of those in the green, which means outperforming, or pretty much in the last week, they're breaking even from an overall vol perspective. We haven't seen green on these reports since pretty much the pandemic started. So maybe one or so here or there. That's really about it. So the whole season averaging out at 86% right now, which is a far cry from the numbers we've been seeing out there of late. Gary, I'm curious for you. I know you have a lot of different clients over there at Raymond James looking at a lot of different things and a lot of different drivers for their trading activity out there from an options perspective. How big of a driver is earnings season for those clients and for you guys over there at Raymond James? And if it is, what are some of the things you guys are watching out there?
Okay. Yeah, I'll take this in a two-parter if you'll indulge me on this. There's advisors that are looking to run programs, and for those folks, we would say avoid earnings, avoid the unknown. Don't risk not knowing the full information. This data is great and it helps you make a decision, but for the managers that are looking on the long-term horizon, obviously you would want to avoid an earnings event because you just don't know what's going to happen. Is good not good enough? Is bad but becoming good better than expectation? We just don't know, right? Like look at Zoom. I mean, the implied move was showing down, and sure enough, it got hit today. And the way I look at a company like Zoom, right? Maybe the valuation is coming back down to earth, but it's become like Scotch tape or Kleenex and, all these kind of things. Maybe it's going to, maybe that's the new paradigm shift, right? We without Zoom, we wouldn't have made it through this last year. It totally changed everything, right? But it got hammered today because expectations weren't good enough, right? So thinking of that, I always in the back of my mind, people that are buying straddles, one of the flaws that's so simple is, okay, if the stock drops, they let their call expire. Well, if you can collect, say you paid, $2 for buying your calls and puts, and the stock in the case of Zoom went down today. They're so hyper focused on the put side. They go, oh, well, the calls are only worth like 20 cents. I'll just let them expire. It's like, why? That's free money you left on the table. Close out the other side when you exit the side that's profitable. And also with those kind of scenarios, when you're coming out of earnings, don't stick around too long because, you can be right, but the vol crush of the news event is now out there in the open. And when you get rid of the uncertainty, vol has no choice but to come down. Get out of the way, right? Whether the trade is successful or not, being successful long term. And I was never a market maker or held a proprietary positions in a book. But I understand from my own personal experience, when the event is over, get out of the way, right? Because with options, time decay is not your friend when you're long. So the discussions we're having with our advisors and our actual clients is have a plan, stick to the plan. Whether that is, exit 50% of the position, exit 100% of the position when certain events happen, you got to do that. That's the only way that you preserve capital and go from accumulating wealth to maintaining wealth. So that's our focus over here.
Yeah, that's a great point, Gary. Both two great points, I think. One is when you have a view of a straddle, close it out. I'm guilty of that. I'm hanging out at some old earnings plays, and I'm kicking myself. And the other one is something that we've tested on our blog. We have this covered callback test where we looked at millions of back tests on the top stocks. We looked at days to expiration, which were the best deltas, which were the best skew times, and whether you should stay in or during earnings or avoid earnings. And the results that came through was the best maturity was about 1 month, and avoiding earnings was better than trading through earnings. So that's for being on the desk for so long. I need to have 3 million back tests to tell me, but that's the value of back testing and the value of experience. So anyway, Mark, that's two great comments from Gary. It's great to have these guys that you find and come on, and even I learned stuff. So I appreciate that.
We're all learning together, and let's see if we can learn what's going on in the world of options. It is time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, let's get the buzz here. Of course, the portion of the show we break it down out there in the world of options and derivatives because, you guys have another job, which takes up a lot of time out there. And one of the questions, Gary and Matt, that everyone has been asking since this year began, I think it was almost just an assumption coming into this year that 2021 could not keep up with the record pace we saw from an overall options volume perspective. 2020 was, a record historic outlier year by just about any metric, certainly from an options volume metric. And so it was kind of assumed coming into this year that we'd see a little bit of a drop off, maybe as things mitigated somewhat on the pandemic front. Folks went back to work. Of course, we're not maybe seeing that as rapidly as some folks would have hoped. But coming into this year so far, the story pretty much month after month has been, can the party continue? And the answer so far, pretty much every month has been a resounding yes. We are on the heels of having the numbers for August, but so far, since our last show, we have received the numbers for July from our friends over there at OCC. And July, once again, another history-making month. The most active, highest volume July in the history of the business. So pretty much every month this year, pick whatever month it is, February, April, whatever, it's the highest volume of that month that has ever been in the history of the options market. It overall is also the fifth busiest month in OCC. So not quite the number one spot, but again, this is a pretty crazy year. It's kind of hard to make that number one spot every month. So July comes in on the record books at number 5 in the overall. So I think you've looked at the top 5 months in history, they pretty much all have been this year. I would pretty much wager maybe 1 or 2 towards the end of last year, but they're all very recent. That's for sure. July 2021 volume, 794, almost 795 million contracts, up nearly 30%, 29.2% from this time last year. If you remember last year, listeners, 2020 was no slouch, as I mentioned, from an options volume perspective. So the notion that we could be up 29% from that's pretty shocking, pretty surprising, quite frankly. And also interesting to see year-to-date average daily volume, how much volume is actually going up every day out there in the options market. Again, last year, a ridiculous outlier year. And so far this year, through the end of July, it was 39.2 million contract. That's up 38.2% from this time last year. So if things continue apace throughout the end of this year, then we're looking at, nearly a 40% increase in ADV from this time last year. Just, these are insane numbers. These are not numbers. At the end of last year, everyone thought that was a ridiculous outlier we would never see again, at least not for any time soon. And we're already on pace to perhaps exceed that by 40%. Gary, I know you've been down to the OIC conferences. We've chatted down there in the past, so I know you keep an eye on the industry overall and keeping an eye on what's going on from an options volume perspective. Are you surprised that the party is quote unquote continuing out there, or did you kind of expect these types of numbers to hold steady so far throughout the entire year, Gary?
Last year was crazy. We were like, no, there's no way we can continue this, right? I mean, the growth, here at Raymond James, at least in the last 8 years that I've been over here, we've been growing every year as the firm has grown. And then last year just blew away everything. But you know what? This year we're blowing away last year's numbers. We're on a physical year end, which actually is the end of September, and probably a month and a half, maybe 2 months ago, we had already beaten our fiscal 20 calendar year. And looking here this month, like we're talking about July's numbers. I can tell you our August numbers are ahead of July. And we're in the middle of summer. What happened to sell in May and go away? Right? I mean, it just keeps going. And I was kind of a little side note. I was on a call earlier this week with our asset management division, and one of our portfolio managers that runs a couple of $1 billion. One of the questions was from a different take of where the options market is and what it's become. Is okay. You guys are at a couple of $1 billion. Do you think you're having trouble interacting with the market when it's time to roll your position or add a new position or whatever? How is your trades getting off? And based on where the market is now and how well the system works, knock on wood, I don't want to jinx it. They're like a blip. The market, the liquidity, the depth, the tightness of spreads is incredible. And it keeps on going. So to think that this is the peak, maybe it is. And to think where we were even 3 years ago, 10 years ago, 20 years ago, it seems impossible. But it keeps on going. And a firm like us, we're not necessarily big on the meme names, but just think what our volume could have been if we were more active in those names. So, I mean, I think the future looks really, really good.
Yeah, I mean, you're right. These are the dog days of summer. These are the times when no one traditionally is touching options. They're all on vacation. They've all left New York and Chicago for the beach or somewhere else. And, the junior guys on the desk and the markets are thin and nothing's going on out there. And yet you're right. We're seeing these ridiculous record months in July and maybe even into August. So crazy times afoot. Matt, I know you watch these things as well. What are your thoughts on overall volume? And also to Gary's point, anything interesting catching your eye out there in terms of the width and indeed the liquidity we're seeing out there these days?
Yeah, I do think it's a different market. It's not just New York. It's now you're seeing not just the Robinhood effect, the Reddit effect, and all the people chatting up, and there's just a lot more interest in the market. And that's evidenced by these like way out of the money calls. I know I mentioned this quite a bit on this program, but they're still about the 5 delta call divided by the 75 delta call or puts are about even, like where usually you see the lower strikes, 75 delta call, I should say, are much higher volatility in the component stocks. Now, in the index stocks, it's different, as I mentioned earlier. And yeah, we also track the market width, the bid ask and volatility points, and that has just come straight down. It's just getting to pre-COVID levels, but that really got high. I agree that the liquidity is there now, but the COVID crash really exploded, and you weren't able to get very good liquidity. So it's coming back, but I think the nature of the markets now, there's a lot of liquidity there. When the markets start moving, people jump out of the way. It's not like when I was a market maker, we had to keep making markets during a duress, whereas now it seems like people just really widen out their markets, and when it gets really ugly out there. So I mean, I think right now definitely there's a lot of trading going on, a lot of liquidity. I do worry about if something happens to the market, the markets being there, Mark.
Speaking of things happening out there, we talk every episode really about what's going on here from a domestic options perspective, and they've been blowing the doors off. OCC numbers have been robust pretty much every month. But there is a lot more going on than just here in the U.S. We are the lion's share of it, obviously. But if you want to look at a more global perspective, our friends over there at the Futures Industry Association, they track all of that stuff, not just the options, but the futures, the entire global derivatives pantheon out there. And guess what? They have the numbers out now for the first half of this year. And spoiler alert, global futures and options trading also kind of blowing the doors off. So the party is not just here, it's kind of all over the place, that the global derivatives bonanza is continuing just at record levels. Global futures and options trading hit 28.9 billion contracts. That's billion with the B, listeners, in the first half of 2021. That's up 32.1% from the first half of last year. Again, the first half of last year, no slouch when it came to overall volume. Now, they track everything, all the commodities, you name it, across all the different areas. They also track different geographic areas and see where the volume is really coming from, where the growth is really coming from. And so far this year, in particular, breaking it down by the second quarter, they saw 14.08 billion contracts trading worldwide. The record, though, was Q1, 14.83 out there. So Q1 is kind of still the record out there. But overall, up strong from last year. OI, of course, the open interest, the number of actual contracts, the positions that are outstanding out there. Those are also up from this time last year. Total open interest at the end of June, 1.08 billion contracts, up 11.6% from this time last year. Of course, that indicates people are putting on more positions, but also there's a lot more trading going on. There's a lot more churn and burn going on. People aren't just opening positions in the same percentages that we're seeing, of course, out there in the growth of overall volume. So a lot of trading going on, a lot of more short-dated type trading. You want to look from a geographic perspective, where is the growth coming? It actually wasn't in North America. North America grew, but we saw the Asia-Pacific region having the largest absolute increase in overall volume. Latin America came right behind it at number 2. The U.S., though, no slouch. North American exchanges growing by 15.4%. Europe actually dropping a little bit. European volume actually down nearly 12%. All of that compared to the first half of last year. And from an overall asset class perspective, again, going back to that kind of short-dated churn and burn, the reason for that is because mostly equities are driving this lift in volume across the board. So it's not just here in the U.S. where folks have an equity trading bonanza and the options onset equities. No, it's all around the globe. Equity markets contributed the most to the global surge in trading activity. Volume on single stock futures and options soared 72.5%. That isn't even the indexes. That's just single stock futures and options soared 72.5% to nearly 3 billion contracts, 2.97 billion contracts. You throw in equity indexes there, index futures and options. That volume also up 32% to 2.82 billion contracts. So a lot of volume across the board, a lot of volume around the globe, and a lot of volume in the equities. Gary, I know you're mostly focused on the domestic side, but still shocking and interesting to see how much of this party is continuing, not just here in the U.S., Gary, but also around the globe from a derivatives perspective.
Yeah, don't forget, we still have the reopening trade that's going on. There's so much pent-up demand of people wanting to go places or buy something or get the new refrigerator, for example, or whatever, or a car. There's chip shortages. The whole world is really reopening. We've had the vaccines in our country, but there's other countries that are just now receiving them, right? So there's so much opportunity that's still going on. We're so used to the instant news. We got 24-hour news and everything's on the feed and update, but a lot of things take time to reestablish. So it's really not surprising,
Well, what is surprising is some recent news breaking not that long before showtime. We also had some listeners asking about it, so we'll rope in a listener question as well. This listener question came from Albert. He says, what do you guys think about the pending SEC crackdown on payment for order flow? How will this impact the broker and advisor spaces? Well, you're listening to the right show there, Albert, because, of course, as he mentioned, big news coming recently when CFTC, or used to be CFTC, now SEC, chairman out there, Gary Gensler, they asked him about, what about banning payment for order flow? And he said, all things are on the table. This is a market change from previous administrations. I mean, this debate, this issue on payments goes back decades, listeners. In fact, we don't really talk about it a lot here on the network because until the last few days, there wasn't a lot new to be said. The SEC's position was pretty clear. They were allowing it to happen, and they continued to kind of keep punting down the road on this issue. I can recall back being on the floor of the SIBO back in the late 90s, listeners, and trying to get the SEC to listen then on some examples of maybe why payment for order flow wasn't the best thing. And it put the customer's needs maybe were diametrically opposed to what the firm was getting paid. And so that was an issue. Conflict of interest between the firm and their customers is never a good thing. And so we tried to shine attention to this decades ago without much success. And so to hear Gensler now, of course, potentially opening the door to revisiting that is interesting. And also, of course, from a broker, dealer, and advisor perspective, this is a big deal because a lot of the firms, including everyone's focusing on Robinhood, they're kind of the marquee example of this. But a lot of the firms out there generate a lot of revenue from selling your order flow out there, listeners, to the liquidity providers and other firms out there who want to interact with it. So this is interesting. It does, as you're right, Albert, it does kind of open the door to a lot of interesting conversations about what can happen. Of course, from an options perspective, this is a big business. It's not just stocks. This happens in the options world as well. You're seeing a lot of your flow being sold all over the place. And again, it's a very contentious issue. People line up on both sides of it. People say it creates conflict of interest between the brokerage firm and the clients. On the other hand, the brokerage firms say, well, this allows us to fuel all the great platform upgrades and the low commissions that people have come to expect, indeed demand in the option space. So there are people on both sides of this debate. But it is interesting to see that this is now once again a debate. For a long time, it seemed like it was kind of just settled business. Payment was here to stay. And now maybe that isn't the case, and that could change things up. Matt, I know you've been around the space for a long time. You were there back when people were debating this on the floor in the 90s and early 2000s. Once again, payment kind of a hot thing again. What are your thoughts on, as Albert puts it, what are your thoughts on the pending, perhaps, SEC crackdown on payment? And how do you think it's going to impact what's going on in the brokerage and indeed the advisor space?
I guess I'm a little salty on it. Ethically, I mean, we would be thrown in jail as market makers if we had any agreements like this. But apparently other brokers could do this. So I'm a little salty on from that perspective. But, just looking at it, they fly these balloons and, money flows into Washington and lo and behold, nothing happens again. Robinhood shook it for a little bit, but now it's up on the day. So, I think that people would kill Robinhood if it was really serious. So the people in the know. I don't know whether to get all worked up about this. From a market making perspective, I'd like to see more orders going to the market for fair and open. And a lot of these people are trading on Robinhood and they don't understand valuations. At ORATS, we work hard to come up with these smooth market values that are what we think are the fair values to trade at, and really spend a lot of money and a lot of time to develop these. But they aren't even looked at by a lot of these traders. They're just buying at the offer, and spending a lot of money to trade. And, the other side of that, these market makers are happy to take that flow and pay a lot of money to the brokers. So what are the incentives for the brokers to provide good tools to their clients when they're getting so much money from them paying astronomical slippage? So, it's a little frustrating to me. It doesn't, my guess is nothing's really going to happen. I hope it does, but it doesn't look like much is going to happen, Mark.
Yeah, it's hard to get too fired up because, like you said, Matt, we've been around the space for a little bit and we've heard this song and dance before. So will they actually do something about it or maybe not? That it's hard to get super, fired up. But maybe, again, this is the first time we've seen any cracks in that PFOF debate, which is kind of interesting. Gary, like I mentioned, this is a very contentious issue. There are people in the industry on both sides of it. You're a kind of our de facto broker representative out there today. So I'm curious for you, as our listener puts it here, what are your thoughts on these recent comments from SEC Commissioner? And as he puts it, how do you think this will impact the broker and the advisor space?
So yeah, let me take the counterpoint now, and let me be clear. These are my words and not the words of my firm, right? And let's go back in time because I'm on the other side. I'm on the client side, right? And I remember in the 90s, we used to pay instead of collecting payment. We used to pay when we had to go to just one exchange at a time, and it was one shop. The spreads were much wider, and the firms used to pay to execute those orders. Let's say 50 cents a contract. It's flipped the other way, where a lot of times they're receiving payment all these years later. And let's not forget that the markets have gotten tighter compared to where they were in the 90s, compared to where they were in the early 2000s. We've kind of gotten spoiled where we think the markets have widened out, and they kind of have a little bit, because there's other factors that are involved, but kind of thinking about from the payment point of view, and my firm no longer accepts payment. We discontinued it, but I'm still, for the sake of this argument, I'd like to discuss it. When, let's say, a Robinhood or any other firm that does accept payment sends that order out, they still have the obligation to meet best markets, right? Best quality of execution, the NBBO, the National Best Bid and Offer. So they're still meeting that obligation. And a lot of it is price improved. So it is there. And one of the things that you're doing by, instead of going directly to an exchange and interacting with that one person, you're exposing yourself through your consolidator. The consolidator receives the order from the brokerage firm. The consolidator puts the order into their black box in a millisecond and looks at all, in most cases, 16 exchanges and decides where's the best place to be with this order. Is there the ability to price improve this order? And let me go after it, right? Whether they interact with that order on the other side or not, there is exchange-sponsored rebates that come back to the firm that helps fund this payment for order flow schedule that's out there, right? So with all that in mind, having the option industry all the way back to 2000 have an SEC system in place for these mechanisms to work. I think the industry is getting a bad rap in a lot of ways for being transparent, right? You want something for free, you're getting something for free. You're meeting what you see on the screen, you're getting that sale or better. What's wrong with that, right? And on another piece of this to keep in mind, even though you're meeting all those obligations, is by going through a consolidator who takes my order from my firm and an order from another firm and goes in together, there's actually pricing tiers at the exchanges. The more volume that comes in, the cheaper it is to execute that trade. If we went in just as Raymond James, we would never hit those higher pricing tiers, which means it's cheaper for us to execute the trade. But using a consolidator that's spending multi-millions of dollars to decide where the best place to be is, they're also putting everybody's orders together and hitting those higher pricing tiers, which means it's actually cheaper to execute. Well, sharing that economics around the industry is a good thing in a lot of ways. And once again, being transparent about it, the spotlight is on us because the transparency is there. Which would you rather be in? An industry that doesn't have transparency and is open to scrutiny, or another area that doesn't have transparency and maybe doesn't have the spotlight on them today, and maybe gives inferior prices. So, I'm wearing at this moment the soapbox side of the hat for kind of taking the pro point of view. I do agree that there is some room for maybe restructuring it, but I do want to make the counterpoint that the industry is transparent. It is a great execution, and this business of free trades, nothing's for free, right? You're getting what you asked for, and getting it for free. I think there's something to be said for that. Now, people that take it to the extreme, that's on them. But I'm open to the chairman's review of this, and look forward to it. I hope that the member firms can have input, and the exchanges, I feel like they should have input, and actually take a leadership role in this to come maybe to a better resolution. But we've come a long way from where firms used to pay for the business to getting it for free. And now there's some rebates in there, but the rebates have taken given the client the ability to trade, and a successful trade doesn't have to be, hurt by the transactional cost. So, all right, I'm going to take my hat off for that. And once again, these are my words, and I'm just trying to shed a little light on how transparency is not necessarily a bad thing.
No, I'm glad you want to do that, because a lot of us former market makers, and we have a lot of us here on the network, we're all still a little salty about the payment for order flow. It did kind of reshape the business in many different ways, and it did drive a lot of market makers out of the business, and it left kind of the Citadels and others with the deep pockets out there to remain and kind of be the liquidity provider. So a lot of them are still have issues with the payment. And certainly in the early days of it, when I was talking about it, in the late 90s, when we were first butting up against this, you were right. You were talking about a very different environment. Trade throughs were common. The NBBO, like it is now, didn't really exist to any real extent back then. So you could have broker firms that were doing this. They were, of course, trading their customers' orders at demonstrably worse prices and getting paid to do it. So there was a lot of shenanigans going on behind the scenes. That environment has changed a lot in the last 2+ decades out there. We do have an NBBO now. Markets are tighter, a lot more difficult for a firm to get away with those kind of shenanigans. That said, people do still hold up firms like Robinhood out there as kind of the whipping boy for this, because when they first launched, they were very cagey about whether or not they were accepting payment, and everyone in the business said, well, of course you have to be, because if you're not charging commissions, then the customer is the product at the end of the day. And they were very cagey about that very early. And it wasn't until filings emerged later on that they realized, yes, they were selling their flow, and they were doing it for exorbitant levels. And that kind of practice, that lack of transparency, has kind of been where I think a lot of people have had issues with this. We could debate this for hours, and I'm glad to see that this is coming up again. I'm glad we had both sides of it expressed here on the show. I think we'll come back to it in the near future. Listen, I want to get some of you folks on as well. So without further ado, let's get right on into the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, welcome to the office hours, the portion of the show where you folks get at us. So many of you are very patient and wait. Of course, if you're in the secret club, the pro, you get the bump to the top of the list if you're listening live. Before we get to that really quickly, a lot of you have been asking for the return of our questions of the week. We have had those. Now you can find those over there at Options, the big picture questions of the day, volatility, things like that. Given what we're just talking about here with the broker-dealer space, we have a flash poll up right now. It's only going to be up there about a day or so, which is another hot issue in the space. Rumors are swirling as we speak that PayPal about to enter into the brokerage game. So I thought we'd ask you folks, quite simply, are you guys going to use PayPal as your broker? Gave you 4 choices, mixed it up a little bit. We said, yes, I like PayPal. I'm okay with them. I'm okay with keeping large amounts of assets at PayPal. Or yes, because I don't like my brokers, I want to switch. Or no, I can't stand PayPal. Or no, I'm very pleased with my broker. And right now, it was just ticked as we were talking. It was about 50%. Now it's about 46.5% saying, no, I'm pleased with my broker. I'm not going anywhere. So I know a lot of the BDs in our audience will be happy to hear that. Followed by number 2, nearly 29% saying, yes, I will try them. I like PayPal. So that's interesting. Perhaps a higher percentage than I thought. And then 25%, so almost the same percentage though, saying, no, I don't like PayPal. So interesting. Yes, I don't like my broker. It does not come up at all. So interesting out there. That's got, less than a day left. So get out there at options. If you're listening to this on demand, you probably will still have time to get in there and vote. All right. Let's go on out here now to MTL35. He or she wants to know, I very much enjoy your advisor's option program. I've listened to the entire archive now, and it has improved my client approach to derivatives tremendously. Thank you for your assistance. It's invaluable. Well, you're welcome, MTL35, and everyone else out there who's enjoying the program. We're glad to see it's serving you as you're serving your clients. That's kind of the whole point of the show. He or she goes on to write, I also have a question if you have the time on your I love they're so polite. Yes, we have the time. Said, where do we currently stand on the collar strategy? I agree with the host that collars can be the, quote, holy grail for financial advisors. However, the current extreme, he puts extreme in all cap, extreme bid to out of the money index puts makes executing such a strategy difficult to prohibitive in the current market environment. You're stuck not getting much protection or giving up too much upside to make the two legs offset each other. Am I missing something? Is there a better way to approach collars in these high valuation markets? All right, a lot to unpack here. Maybe Mr. Matt, will start with you, kind of our go-to trade structure. By the way, MTL, hopefully you're listening to the most recent episode we just did last month because we did a deep dive into collars there. So if you missed that one, check it out. We kind of just revisited collars. But that said, Mr. Matt, what do you have to say to Mr. and Mrs. MTL? A, they love the show. They're big fans. And B, they're having problems right now because the puts are so rich, finding a way to put on collars effectively, sir.
Yeah, I empathize. They're, as we talked about earlier, the easy way to do this, everyone says zero cost collar, but, if you're trying to get a zero cost collar, the puts are so cheap relative to the calls are so cheap relative to the puts are going to be way out of the money. And exactly like MTL says, you're giving up a lot. So what do? Well, if you're going to go with a collar, you should treat them separately, treat the legs separately. So with the puts, I like to go way out. We've talked about this a bit. We back tested, millions of puts, put spreads, 1x2s, all this stuff, and really just going way out over a year, out of the money. And what you do is you get the Vega. So when you get a big market correction, and of course it depends on what you're wanting to protect, but generally on a big downturn, you're going to get a huge Vega kick. And so you're going to make that extra amount on those puts that are long dated. Now the calls, the problem with selling the calls, especially in markets like we've seen, is you're giving up way too much. A lot of investors are selling these calls and they're giving up a lot of the appreciation. And why be in the market if you're going to be selling calls? So, we've tested a lot of this, and it's usually you want to look at, shorter term out of the money. You're not going to get too much premium, but if you think about being a very long term put and then having short term out of the money calls, to chip away at the cost. I mean, that's the big thing is the cost. What we're testing some very what I would call creative and innovative ways to hedge, and our clients have really pushed us. We're testing a calendar iron condor right now, if you could believe that. So it's a little bit too complex to get into right now, but and I should also add it's somewhat delta hedged. So you have a very complex, a zero cost collar is easy to understand, but not that good. But the best trades that we're seeing are these much more complex things. It's not that complex. It's a calendar, put and call calendar with, some delta hedging in there. So, I would say that's complex, but not crazy. But that's where you have to go in order to hedge your portfolio effectively, Mark.
I like that. The calendar iron condor. I look forward to, you always have a new strategy up your sleeve whenever you come on. I look forward to diving into that on more detail on future shows, Matt. Mr. Gary, same question for you. I'm sure this is a strategy you folks utilize a lot over there at Raymond James. We've called it in the past on this show the holy grail for financial advisors because it combines the two most pressing needs, the protection and the income, into one position. But as our listener points out, that can be a little challenging to execute right now. What are your thoughts on collars in general? Are you big fans over there at Raymond James? And then B, if so, how do you like to utilize them, particularly in these somewhat lofty markets?
Right. It's funny this question comes up because this last weekend, I'm kind of like a songwriter. When an idea comes into my head, I grab my iPhone and I just start taking notes. And I have a working title for, we have in some, internal documents that we present to the advisors, and I have a working title called the crooked collar, where not all collars are the same. So what are you looking for? Because hindsight is 20/20. If we knew what was going to happen and we had a crystal ball, it'd be so easy, right? But when you're putting on a collar, it's a stock that you're not really wanting to sell, but you want to have that protection. So, do you want it to be real tight? So like 5 up, 10 down, 10% up, 15 down, and getting to that zero cost in a lot of cases in this type of market is hard to do. But taking it full circle, the question to the client is, okay, we know, you love the stock, maybe you work at the company, whatever the story is. Stock has gone up 20, 30%. It's had stock splits, all of that. The question is, where would you like to go to sleep tonight knowing that's your floor? Okay, and then we start from there. So if that's, 20% down, 25% down, that's our starting point. Do you have a certain event in mind? Another way of saying that is, how much time do you need, right? So a lot of times, if there's not an event in mind, we're usually 5 or 6 months out at a time, right? We know where do you want to go to sleep tonight, knowing that's from here to zero, that's your floor. And then we build it from there. That's really what it is. But yeah, I'm working probably in the next month or so. That is going to be one of our case studies, the crooked collar. And so basically, how much of a deductible versus how much pain do you want to feel, just like with car insurance, home insurance, whatever. How much of a deductible you're okay with, and do you need to pay a premium? And then the holy grail of this is if you can get it to the side where it doesn't cost you anything. Now, another angle to that, if you're going to pay a little bit, well, let's say it's a dividend payer. So, a round of dividends maybe pays for that little bit of cost protection that you're looking for. So there's a lot of ways to have that discussion with a client on a stock that they have concentration risk, or they don't want to sell it, or whatever it is. But you're kind of trying to weather the storm and give them that comfort for putting their head on the pillow tonight. That's the way I look at this story.
At the end of the day, that's the advisor's job, right? Let your clients sleep at night and hopefully keep their profits in the process. We're coming up against it. We have a lot of questions, but I do want to go out to the live. The people in the secret club do get bumped to the top of the list. We got time for one more here really quickly. This comes from Nichols in the live chat. He says, John Smolin recommended selling an in-the-money call spread against a portfolio instead of buying pricey puts. He wants to know, Matt, what are your thoughts on that? Of course, we just had our pro Q&A session with Mr. John Smolin earlier today, and people asked him a similar question about, how to get around buying these expensive puts. And one of the ways he thought about, Matt, was selling an in-the-money call spread against it. Again, I know this is last minute just thrown against you. You haven't had a chance to back test that, but off the top of your head, what are your thoughts on that approach to taking some of your risk off the table?
Yeah, I mean, that sounds better than just a call. So you want to get to be collecting some premium that isn't going to really take away a lot of your upside. And but again, in this bullish market, you're gonna that's going to cost you. So you're going to lose on the on the call spread, and you're going to lose on the put. So I mean, we've tested a lot of these. It's very difficult. And it's not necessarily a one size fits all. The funny thing is we've backed up to so many strategies that sometimes what we'll do is find the very worst strategy. Like one of the worst strategies is buying an in the money call and delta hedging it. So if you do the opposite, you sell that in the money call and delta hedge it, and then do something against it that's much further out. That's where we kind of brewed up the Iron Condor calendar. But it's difficult. Mr. Smollen's a very smart guy. He's been around since I started in the business, but I'd like to see that tested, as you say.
All right, listeners, that music means we've come up against it yet again. An hour flies when we're having fun. Gary, you did an able job in the guest chair. I want to thank you for joining us today. And if our clients are intrigued, they want to learn more about what's going on from an options perspective at Raymond James, or if they're indeed advisors and they want to think about maybe joining the options party over there at Raymond James, where should they go? What should they do, Gary?
I would recommend going to our main site, RaymondJames.com, and looking for an advisor in your area and letting them see if they can assist you.
And if they're a lot of our listeners are on the advisor side, obviously. What if they want to join the Raymond James family and start dishing out some options, sir? Where should they go? What should they do?
Yeah, look us up. We're here. During the pandemic, we've been conducting home office visits virtually, and recruiting has been active. I pride myself on, if you're an advisor and you're joining Raymond James, once I've met you, we're going to know you by name, and you can call us, whether it's a 1 lot or 1,000 lot, whatever it is. We're here to help you. We do portfolio reviews. We'll discuss strategies with you and implement the trades as well. So we're here to take you from A to Z.
There you go. So check it out. Begin your journey, whichever side of the fence you're on. If you're an advisor looking to dive in, or maybe you are a client and looking to add some options to your portfolio, RaymondJames.com, the place to go to learn more. Mr. Matt, if folks are intrigued about these hedging strategies, I'm certainly intrigued about your calendar, Iron Condor. If they want to learn more about all that stuff, where should they go? What should they do?
Come on over to our new site at orats.com. A lot clearer, explains what we do a lot better. We've got a great team of people producing online products and content, and all to help all these our great clients. And it was really fun to be on with Gary, and his team is great. I met him down at one of the OICs. So great to be on with you, Mark, and come on over to orats.com. Check out the new site.
There you go. I'm looking at it right now. It is a snazzy new site. Check it out for yourselves, listeners. ORATS, ORATS.com is the place to go. While you're at it, give them a follow on the old Twitter machine. Easy to remember, at OptionRats, all one word. Very memorable handle there. So they're always tweeting out great data and things like we're just talking about here. This Time Iron easy for me to say, Time Iron Condor, and everything else over there at OptionRats. Give them a follow. And of course, while you're checking out options information on the web, check out optionseducation.org. Our friends over there at the OIC do a great job of getting education out there to the masses. No agenda. They just want to teach you what a call is, what a put is, and everything else in between. You can begin your journey there, optionseducation.org. And of course, our journey on the network continues throughout the rest of the week. We have Education Wednesday coming up. I know for a lot of you who are looking to learn more about the options space, Options Bootcamp, Options Playbook Radio, 2 great sources for that. Thursday, we have the double dose of This Week in Futures Options and episode 2 of the Option Block. Friday, Volatility Views, followed an hour later by, for all you pro folks out there, Options Oddities. Then we're back again next week, which kicks off another month. That means another episode coming up of the Advisor's Option. We'll see you then.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.